Thanks so much for joining me.
Always a pleasure, John. Always a pleasure.
You just talked here at the Strategic Investment Conference about the fact that the pension crisis you believe is the biggest macro story in the world right now. Unpack that idea for me.
Well, it's one of two. It's certainly the biggest here in the States, we think. This is something we spend a lot of time on Real Vision, talking to people about this. And as we've done that, it's become clearer and clearer to us that this is not only a huge problem, but it's a problem that's misunderstood by a lot of people. Demographics in the US, we've got the biggest generation in history to retire. The millennials are a bigger generation, but they're not a problem yet. Unless you're the father of two of them, in which case I would may alter that. But this generation is retiring right now, and the pensions, both state and private, are underfunded massively.
Right.
They have the biggest allocation they've ever had in their lifetimes to equities at a point in time where we are due a recession. Whether we get it this year or next year, it doesn't matter. At the point that they are retiring, in their millions, they are going to have, in some cases, up to 70% of their portfolios in equities. And in recessions, bad things happen. If you look at the average recession since 1980, it's 37% drawdown in the stock market.
Right.
So you don't need to have a math degree to figure that out. It's a really bad outcome.
Yeah.
At the 2007 highs, the average American had 1.27% of their portfolio in the bond market. Now, at a time when retirees are going to be forced to sell their equities, they really need to own bonds for income. A, they have no income because the Fed has taken that away from them.
Mm-hmm.
And B, they're going to be forced to buy instruments at 5,000-year highs.
Right.
It's a whole collision of bad things, crystallizing around a generation that have had it really good their entire lives and think they're going to go off into the sunset and canoe and play golf and garden. The reality is they don't have enough money to retire, and they could face some serious problems in the coming years.
You say serious problems, and I've heard these slowly being talked about over the
Yep.
last probably couple of years, but you really crystallized it with what you said this morning here at the conference. How bad is it really going to get for people? Like, really
Well, look,
spell it out.
According to the Federal Reserve, the average American, according to the US government, the average American has $186,000 saved for retirement. If you go to BlackRock, it's 136, and I tend to believe BlackRock over the US government. If you take the average boomer, they have $1.1 million in retirement assets. That's their equity portfolio, house, some bonds, some savings, which sounds great. And that's I think, conducive to a happy, healthy retirement. But when you strip out the numbers and you take the median instead of the mean, which gets rid of the 1% problem, there are a lot of very wealthy people in America, the numbers collapse. And instead of 1.1 million, the average boomer, the median boomer, has 200 grand. Now, return assumptions are fixed at 7% still. People refuse to go down and say, you know what, return assumptions are probably 2, not 7.
Yeah.
The magic of compounding makes that a big problem. Even at 7%, you're talking an income of about $9,000 a year, which is about $35,000 shy of the ideal retirement income of about $45,000. So these are not complicated numbers, but the scale of the problem is so big that they're numbers that people either assume are wrong, or they kind of think, well, something will be done to fix it, because that's the culture we've created over the last 20 years. It will be fixed. The problem is that these problems don't get fixed until there's a crisis. They don't get fixed in advance. No one, I guarantee, in Washington is looking at this and saying, this is a problem, we need to fix it now.
Right.
It will become a problem and something will have to be done. But by then, millions of Americans are going to have seen their retirements just crashed. And it's something that people aren't talking about. A, because it is a big kind of intractable problem that you can't really get your head around because the numbers are so big. And B, because people don't really want to hear it. You don't want to be told when you go into, even if you probably understand it deep down, that this retirement thing is going to be, I'm going to have to really watch what I spend. And when people retire, their spending collapses. And so you're going to see that happen, but even once it's collapsed, people are going to be forced to sell their homes. Millennials are going to be forced to renege on student loans to help their parents out, move in with their parents. I mean, things are going to happen that are driven by demographics, and those are long-term, multi-decade trends that you can't change overnight, because it's a slow-moving train that you see coming. It's Austin Powers in front of the steamroller. No, and the thing's moving towards you at half a mile an hour, and you stand there. But it's coming this way, and it's going to hit. The wave is going to hit.
Okay, 2 quick tracks I want to go down on this. First off, and you touched on it briefly, but I want to go a little bit further here. Retirees are always the biggest voting bloc
Yeah.
when it comes to any sort of political race, especially in the U.S. As soon as that bloc, starts realizing the direction they're heading in, these votes are going to start going a certain direction. What is the government going to do about these people who are voting for, we want more money, and what does that mean for the rest of us that have to pay taxes?
It's a great question. The government, the simple part of that to answer is the government side. The government will do whatever they think they need to do to get in power. Right? Or stay in power.
Yeah.
That's what they'll do. Unfortunately, it's going to require, either giving people money or changing legislation which will massively reduce their taxable revenue, taxation revenue. And again, every time you have these conversations, you come back to this idea of there being so much debt in the world. We don't have any options here. We've spent away all our options for the future. So they will be forced to write checks because the other side of it is going to be catastrophic. Means-tested checks, it's not going to be fair. Everyone's not going to get the same crack of the whip because that can't be done with this because it's just too big a problem. So, I don't know exactly what they're going to do, but I do know they're going to have to do something because it's just too big a problem. And I also know that they won't do something until the pain is already being felt.
Right. Okay, so how do investors play this then? What should they do?
Well, frankly, they get out of equities. Obviously, it's different if you're a millennial, you've got time, that's fine. But if you are my age and grey-haired and looking towards retirement rather than a healthy future running track, you need to think seriously about your equity allocations. So at the top end of the wealth pyramid, people have 70% of their assets in equities. These retiring boomers. Now, you might think you're a wealthy guy. You take a 40% haircut on 70% of your assets, you're not a wealthy guy anymore.
No.
Because you've extrapolated a certain standard of living and that's going to cost you a certain amount. That's gone. You have to make plans in a hurry. So for investors who are getting to that, they need to understand this. This year, the boomers start turning 70 and a half. There's an IRS law, the required minimum distributions, that's going to force people, the year they turn 70 and a half, to sell 5% of their IRAs and 401ks, and have to sell that every year. So these are forced sellers. And because of the tax implications, it's going to make sense for boomers to retire early before they have to start selling this, because once you get the income from this, it puts you in a whole new tax bracket. So things are going to start happening that a lot of people I don't think have thought through and aren't aware of. And when we put this presentation together, we've talked to people about these RMDs, and people didn't really understand and weren't aware of them. It's happening right now. 1st of April this year is when the boomers started turning 70 and a half. That's when the selling starts. A lot of people in March would have got a notice saying, oh, by the way, you have to sell 5% of your 401k this year, or be penalised and face a huge tax bill. This is a real problem, and it's not talked about enough. People don't understand the ramifications of it, and so what we tried to do in the presentation was just make people curious, if nothing else. Walk away from that saying, wait, I need to find out more about this, because when you look into it, the plans you need to make for yourself involve decisions that have to be made quickly.
Sobering thoughts, Grant. Thanks so much for your time.
Great.
Thank you so much for joining me.
Pleasure.
You talked here at the Strategic Investment Conference about the Federal Reserve policies and how you feel like they were right in 2008, 2009, but since then they've been wrong. What did they do wrong, and are they continuing down the wrong track right now?
They superbly executed the lender of last resort. They had to. But the reason they had to execute that role is that they had not adequately regulated a massive buildup of debt, which was the root cause of the recession in 2008 and 2009. Then they instituted quantitative easing, which I think has only produced the most marginal of positive benefit. But it has also created a lot of negatives. One of the most glaring is that this liquidity has fueled record leverage of the business balance sheet. And we're more leveraged in the business sector than we were in 2008 or 2009 or any other time in our history. And I think that what the Federal Reserve did is they said to the world that we're undertaking quantitative easing so that we can boost the stock market. And the stock market will then produce a wealth effect, and this will invigorate the economy. Well, the wealth effect, which is a big item in the Federal Reserve's econometric model, is in fact not empirically observable. And this is the worst expansion
Yeah.
in U.S. economic history going back to 1790. By far the worst expansion since the end of World War II. And we've had a very strong stock market. There's not enough ownership by enough people for the stock market to benefit. However, when Bernanke and then later Mrs. Yellen said that their objective was to boost the stock market, it was a sign to the business executives to emphasize financial investments over real investments. The Fed's backing your play, and you can engage in financial engineering, buying back your shares, buying the shares of others, raising dividends, other financial transactions. The business managers think that they can reverse those, that the liquidity will be there.
Right.
You install a set of new plants and production lines and so forth. If the demand doesn't materialize, you're stuck with it. You're not going to be able to liquidate it. And so, in essence, what the Federal Reserve mistakenly did is that they encouraged a shift from real investment into financial investment. Last year, business debt increased by more than $700 billion. And business debt to GDP set a new all-time peak, but investment in plant, equipment, and inventories fell by over 20 billion. And it's the investment, the real investment, which grows the economy. And so the Federal Reserve has, in fact, by this unprecedented program, created very significant unintended consequences, which have undermined the U.S.'s capability to grow, to have gains in productivity, and to lift the standard of living.
So they're going to hike rates twice, they say, in the next.
They say that.
They say that. It's going to happen?
For me, that whether they do that or not is immaterial, because already the Federal Reserve policy is biting. In raising the short-term interest rates just a small amount and to a still low level of less than 1% on average, the Federal Reserve has already engineered a contraction in the reserve aggregates. The rate of growth in the money supply is declining. Bank lending has dropped even more precipitously. All major categories of bank lending are slowing, from business loans to consumer loans to real estate. And the rate of decline in velocity has increased, which means that monetary policy is intensifying. So if the Fed goes through and raise the rates another 2 times, what they will do is they will shift the supply of credit curve inward, cut the downward sloping demand for credit, raise the rate. This will put more downward pressure on the monetary and credit aggregates. And one of the things that I talked about was that since 1915, of the 18 recessions, all of them were preceded by monetary tightening. The only one where there was no monetary tightening in a recession was when we ended World War II. And we lost the export markets and the military spending and so forth. But all of the other 17 recessions were preceded by monetary tightening. The Federal Reserve is on very thin ice. We're in a late stage expansion. Pent-up demand is exhausted. We could see this in the automobile sector.
Yeah.
We see it in apartment construction. We've had a major boom, unprecedented boom in apartments. We've had a major advance in the building of retail properties and offices. And we're seeing declines now in used car prices, new car prices. Rents are beginning to fall across the board. And there's even some indication that the pent-up demand for new homes it may not be exhausted, but it's in the process of being exhausted. And so while there are 3 instances where the Fed tightened and we avoided a hard landing, we have never avoided a hard landing when the Fed was tightening as late as it is. April was the 95th month of this expansion.
I want you to quickly shift your perspective a little bit, and from the Fed's perspective, why are they doing this? Given everything you're saying to me right now, what's in it for the Fed?
Well, the Fed...
Are they stuck?
The Fed basically focuses on what they consider their dual mandates, the unemployment rate and the inflation rate. And frankly, these are, in my opinion, very flawed mandates. because the inflation rate is a lagging economic indicator. It typically does not decline until economic activity is already softening, and the unemployment rate typically does not rise until conditions are deteriorating. And what the Fed should be focused on is achieving financial stability, not managing the dual mandate. Mm-hmm. And they're focused on something called the Phillips curve, that there's an inverse relationship between the unemployment rate and the inflation rate. And in my view, that's very flawed, that the key consideration is what happens with top line growth and our nominal GDP. And right now we're seeing a very substantial deceleration in top line growth, which means that if some transitory factor comes along, like say a doubling in oil prices, the price level can rise for a period of time. But if top line growth is decelerating, ultimately the price increases will be rejected. And so when the Fed responds to a non-fundamental increase in the inflation rate, what they do is they increase the financial instability. They increase the risk of recession. They increase the risk of too much inflation down the road. And so the mandate of the Federal Reserve inherently leads to a destabilizing monetary policy.
Is the Fed going to tighten then? Are they going to continue on this track? Yes or no?
I have to take them at their word that they plan to. I think that it will reinforce the monetary restraint that's already present, and I think that it will serve to undermine the economic outlook at a time when that is not needed.
So investors need to have this baked into the cake. This is happening, and you need to prepare.
The Federal Reserve is off track, and if they tighten, they will be further off track.
Okay, so what does this mean for the long bond then, if you're an active investor?
Well, if the Fed goes again, which they're promising, then that will reinforce the declines in money supply growth, the weakness in velocity, the weakness in bank lending, and will cut into future economic activity. And the long bond is very sensitively economic in economic terms. There are a lot of factors that can move the bond yield over the short run. But we see a pattern here that I think will continue. When the Fed started tightening in December of 2015, the long bond was around 3 1/8, 315, 320, somewhere in there. The Fed funds rate has been raised 75 basis points, but the long Treasury bond yield today is between 2.90 and 3%. We've had 3 rate hikes, but yet between the federal funds rate and the long bond, we've seen a flattening of the curve there. And so if the Fed proceeds ahead with additional tightenings, there may be a transitory increase in the long bond yield, but I think the yield curve will continue to flatten. And between the Fed funds rate and the 30-year, which is an indication that your very economically sensitive long bond investors believe that the rate tightening will have adverse economic consequences. In other words, for long bond investors, it's nothing more than a short-term problem. It will not hurt the value of the bonds longer term.
Well, Lacy Hunt, appreciate your time.
My pleasure. Glad.
Well, you've mentioned in some of your writings the S&P could fall by 1,600 points, around 34% of a drop from where we are now. You call it a machine-driven bubble. Is that right?
Yes, I have, because think about it. The market today is trading at 25 times S&P 500 earnings, which were $100 a share in the period ending in March. That represents a tiny growth from $85 a share way back in June 27, 10 years ago, or about 1.2% a year over the last decade. Now, why would you pay 25 times earnings for 1% growth after a tepid expansion of 100 months that's near the end of its sell-by date? We're going to have a recession one of these days, likely sooner than later, and the market is dramatically overpriced. I would say 16 times earnings where we are today, given all the headwinds in the world, the chaos in Washington, the fact that the Fed is now finally going to begin to shrink its balance sheet, and not just a little bit, but by $2 trillion over the next 2 or 3 years. With all that staring us in the face, the market is barely worth 1,600, not 2,430 somewhere it ended today. So there is a huge air pocket between the fantasy that still prevails on Wall Street and the reality of the economic world and the breakdown that's happening by the hour in Washington. When you have Trump tweeting against his own Assistant Attorney General rather than firing him, like Nixon at least did back in 1973, I think it's just a measure of how absurd all of this has gotten.